Now, the financial markets have also implied there's a 56% chance that this will happen. There'll be a US inflation shock puts the RBA on the spot. Pressure is intensifying for the Reserve Bank of Australia to sustain the pace of interest rate increases. We've seen shock data. US inflation risen again in August. We'll go through that in a minute, but it's actually fueled bets that the Federal Reserve in America will deliver the single biggest blow, biggest increase since 1981. Let's have a look. We can see the cash rate for the US has followed a very similar path to Australia. We can see multiple increases in the last number of months, and US inflation has come in at 8.3%. Now, you're probably asking why the US inflationary data has bearing on what the Reserve Bank will do. Now, the Reserve Bank is influenced by both what other central banks are doing and what they're seeing. The fact that core inflation appears to be stronger in the US puts a bit of nervousness on the Reserve Bank of Australia that inflation might be harder and stickier than what they initially first thought. Now, Australia, we only get the data every 3 months. We fly blind for a lot of the time. As we can see in the US, they get inflationary data every month. So the Reserve Bank goes from quarter to quarter making decisions on where they think inflation is going to land. Inflation for the quarter ending in June hit 6.1%. And we can see here in the US, it was widely expected inflation to come down at 8.1%. It hit 8.3%. Now, we've previously looked at the bank's forecasts on where they feel the official cash rate is going to land. Westpac coming in at 3.35%, saying that was going to hit in February of next year. Commonwealth Bank recently upgrading their forecast. They were officially landing in and around that 2.6%. They've actually said 2.85%. They've revised it and said that the cash rate will increase. And we've seen some new data from Nomura. They're a global financial services group with integrated networks spanning over 30 countries. They've upgraded their forecast and said that the Reserve Bank's October cash rate decision will likely be a 0.5 percentage point increase, which will take the official cash rate to 2.85. They'd previously forecast for the cash rate to hit 0.25%. Now, the financial markets have also implied there's a 56% chance that this will happen. There'll be a 0.5% increase in the next meeting when the Reserve Bank meets up, which would actually mean that this will be the 5th 0.5% increase in a row that we might actually see coming through. Nomura has also predicted that the RBA will peak interest rates at 3.5% in February of 2023, up from their previous forecast of 3.1% by Christmas. Now, the Australian dollar, which fell almost 2 cents to a low of 67 cents, is another reason for the Reserve Bank to be vigilant, because a depreciating currency will further inflame inflation. If the RBA doesn't at least try to keep up with the Fed, they could find that the Australian dollar will be lower, which will add inflationary pressures at a time where the pressures are already elevated. We saw the biggest tumble to the Australian dollar since COVID-19 started on Wednesday, and the fact is there's a scramble for a safe haven in the greenback. There is mounting momentum that we could see a 1 percentage point increase for the US Fed as they meet next week, and this is dash hopes for many that were hoping that they'd see a more moderate pace of monetary tightening. There's a 37% chance of this jumbo move, as there was only expectations of a 0.75% increase before the CPI data was revealed. Bond traders have also pushed up their prediction for the peak rate to hit 4.3% for the US in March next year. Now, this has increased from 3.75 before the inflation report was released. The US economy hasn't seen a 1 percentage point increase in interest rates since the former chair, Paul Volcker, the last time being May 1981. Now, the Reserve Bank will be keeping an eager eye when September's inflationary data comes out to see if it's starting to reduce. They have predicted that it's going to peak around that 7.8%, currently sitting at 6.1 from the latest data we've got. And it's really going to be one of those things that'll be continuously evolving and changing sort of forecasts. And the Reserve Bank being very clear in most recent speeches saying that the path moving forward is really undetermined. They don't have a set path to move forward on, and it's going to keep changing. We can see with a lot of these forecasts, initially was predicted at X, it's coming in at Y, and it keeps changing as things evolve and we start to see what's going on overseas and even in Australia. Knowing what we now know, what can you do if you have a mortgage or you're considering getting in the market and wanting to understand what these interest rates might actually do to your repayments, your commitments, and what you're looking at month to month, week to week? Well, jump on our website, huntergalloway.com.au/extra repayments, and you can see here, you can play around with your mortgage repayments and get a bit of an understanding of what might actually occur with all these interest rate rises. The current cash rate that we are at is 2.35%. They are predicting that the cash rate could get anywhere in the 2.8s, 3.3s, 3.5s, depending on who you listen to. So playing around with the numbers here, you can plug in your loan amount, the years you've got left, and you can look at what happens if my rate goes up by 1%. What happens if I pay extra repayments whilst the rates have gone up? Or what if I pay the absolute bare minimum? Now, it pays to review your mortgage, see if there's way to get the rates down. We've seen recently with the bank's new lending rates versus existing lending rates, they charge about a 1% or a 0.5% loyalty tax. So a lot of times if you've had your loan there, the longer you've had it, the more of a loyalty tax you'll be paying. And that's where working with a mortgage broker like ourselves, we can review and see if there's any ways to get your rate down and give you a better idea on what the market's doing. There are some fixed rates at the moment that are starting to make sense. Previously, fixing in didn't really make sense because there was massive difference between what the fixed rate you were getting versus the variable rate and what the forecasts and the predictions were. Now we can see the forecasts are faring a little bit higher than what previously was advised. It might actually potentially start to work out depending on your strategy. Keeping in mind when you fix in, you are limited in extra payments. Sometimes you don't get an offset account. Other times, if you're going to sell the property, there can be penalties to break that fix. Here at Hunter Galloway, we're mortgage brokers. We're based in Brisbane. We deal with people Australia-wide. So if you're looking to review your circumstances, get in touch with us. We can have a chat. We can look at whether it makes sense for you to fix, if it makes sense to split the loan with the variable and fix, or to stay all variable, depending on your risk profile, where you think the market's going, and what you think the potential for future changes are. Call us on 1300 088 065 or visit our website huntergalloway.com.au, and we'll see you next time.